Welcome back, ladies and gentlemen, to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando, coming to you live-ish, taping on Thursday morning, and as is the case these days, not quite able to do it in the studio, but hopefully here in the next couple of weeks we'll certainly be able to do that, and we look forward to kind of getting back on a regular schedule, if you will. Speaking of regular schedules, here we are mid-April, and that means that you by now probably have gotten a copy of your quarterly statement for the first quarter of this year. And what's interesting about the reaction, and make no mistake about it, okay, those first quarter statements were pretty ugly, and obviously the virus continues to wreak a lot of volatility in the markets overall. But those statements, generally what we're hearing, even though they weren't great, and obviously there was a significant market decline in the first 3 months of this year, what's interesting is the perception when people actually look at them are, well, wait a minute, this isn't quite as bad as what I may have thought. We've heard that a number of times from folks as we've just been talking to them in general here at the office. And so if the statements aren't quite as bad as what you thought, we thought it would be interesting to delve a little bit deeper into why that is the case. And we talked a little bit about that on the program over the past couple of weeks. Obviously, the CARES Act, which is the stimulus package that the folks in Congress passed, $2.3 trillion. I mean, that's a lot of money, 10% of the overall economy, and a 50% increase in government spending over 2019. Huge numbers on that. And obviously, the market is responding positively to that. And certainly the actions of the Federal Reserve lowering interest rates and basically saying, hey, we're going to backstop everything and anything and everybody is a very different play out of circumstances than, for example, what we saw in 2008. So what the markets have done is at the lowest point on March 23rd, so far they were down about 34%. Today, depending upon how Thursday plays out and then Friday, at least at the time of the show, they were down about 14%. So to go from being down 13 to only being down 14 really should be asking the question, okay, so what's going on there and why? And certainly we think the biggest is the stimulus. Obviously, that's a lot of money that is just getting pumped into the economy. But there's a couple of other points that we also want to bring up that I think are getting missed along the way. And because there's a difference between what's going on in the economy versus what's going on in the stock market. And usually those two kind of work sort of hand in hand, but this is one of those times where you have to understand the nuances of the economy versus the nuances of the stock market. Clearly the sectors that have been impacted here, okay, are a huge part of the U.S. economy. Entertainment, leisure, hospitality, retailing, auto sales, the list goes on. Huge amount, and energy, of course. Those are the sectors that have been dramatically impacted by this virus and the shutdowns that have occurred. Those sectors account for almost half of U.S. jobs. 45% of U.S. jobs are in those sectors. Again, entertainment, leisure, hospitality, retailing, auto sales, energy, that kind of stuff that has been most affected. Okay, but they impact the stock market to a lesser extent than you may realize. Why? Because remember, the market is weighted based upon capitalization of the companies that make up the market. Okay, so what that means is that the more valuable of a company I am, the greater the impact I'm going to have on the stock market. Valuation of a company is not based upon the number of employees it has, right? It doesn't matter how many employees you have. If you're creating a valuable product, then the market is going to reward that business and increase the valuation of that business. So remember, stock market based upon market capitalization, which reflects the value of companies, not the number of employees. So that's a key difference. And here's why. Because when you look at the numbers, the most affected sectors in this virus economic downturn account for just 22% of the S&P 500. Let me say that again. The most affected sectors in this economic downturn, this shutdown, this virus-related shutdown, account for 22% of the S&P 500. 45% of the jobs, absolutely, but 22% of the performance of the S&P 500. What accounts for the rest of it? Well, those are the other sectors. So what's the other sectors of the economy? Technology, financials, healthcare, communications, internet retailing. Seeing the difference here? Those may not account for as many employees proportionately, but they account for 78% of the S&P 500. Some interesting numbers on that, don't you think? So I've got all of these sectors that have been dramatically affected and account for 45% of the employees of the U.S. labor force. But at the end of the day, they only account for 22% of the stock market. The other 78%, that's almost 80%. That's a huge chunk. Tech, financials, internet retail, healthcare, communications, they account for 78%. So hopefully that gives a little bit of perspective in terms of what's going on with what's going on in the economy, what's going on when we drive around and we see all of the devastation in the travel and leisure and entertainment and dining areas of the economy that employ a lot of people proportionately, but in fact, from a market capitalization, from an impact on the market, not as much. So an interesting little disconnect that's there that I think many people are missing, but they're starting to maybe see it at least when they look at their statements and say, okay, well, wait a minute, this isn't as bad as I thought. Why would that be the case? That would certainly be the case once you kind of know the makeup and the dynamic of what ultimately drives the market. The second thing to consider is the reality of interest rates, right? So as of Thursday of last week, the yield on the 10-year Treasury was 0.73%. 10-year Treasury, you can loan money to the U.S. government, and that, after all, is what a Treasury security is. And you loan money to the U.S. government, they agree to pay you back over the next 10 years at what you put in, and they'll also pay you a little bit of interest, okay? Classic loan structure. That interest rate, though, your profit, is 0.73% as of last Thursday. So I'm going to loan money to the U.S. government. They're going to agree to give me back my money, and the only kicker I get is an interest rate equal to 0.73% per year over the next 10 years. Okay, so the S&P 500 as of last Thursday was down about 18% from its peak, had a dividend yield of 2%. If it takes, and here's the crazy math, if it takes 10 years for the S&P 500, the markets, to recover that 18% decline. Remember, it made back almost that amount within 30 days, again from the low on March 23rd. But let's just say it's going to take 10 years, okay? The reality is that if it does that and the dividend yield stays at 2%, the average annual return in the S&P 500 then over the next 10 years would be still 4%, which when you compare that to 0.73%, that's 5 times greater return than what you would get if you were owning a U.S. Treasury. So that in and of itself, because of the low interest rate environment, is creating a tremendous amount of demand for the stock market, because the reality is, where else are you going to go? I'm sorry, but 0.73% of a return over the next 10 years is not going to be satisfactory. I hope you would agree with that. The reality is, though, that if you look at the market and just give it a little bit of performance over a 10-year period of time, adding to that the dividend yield that's already at 2%, well, then you wind up with a return potential of 5 times greater than what you would get on a U.S. Treasury, and we're certainly not overestimating what the market might do over the next 10-year period of time. So remember that, and when you're thinking about what's going on in the market and how that all is playing out, because there's certainly still a demand for stocks because, again, the alternative pretty crappy when you look at it from a rate of return perspective. So some things to think about, some perspective in terms of what's going on in the market and what you saw on your statement. Perhaps not as bad as you might have expected, and that is certainly a big reason why. So we will slide to the break. When we get back from the break, we're going to circle back and talk about one issue that all of this virus and stay at home and schools shutting down is creating that folks need to be aware of, particularly if they used a 529 account to pay for college. So we'll talk about that after the break, which we'll slide to here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando.